Hey everyone, I'm Cary Smith and I'm sitting here with Cheri Turner.
Everyone.
And Cheri and I are both with Client First Capital. And so, Cheri, today for our topic, I think it's one that a lot of people need to hear.
Mhm.
And and I thought we would just have a discussion about this. And so I've got a
Yeah.
few notes in front of me. I know you have some in front of you, but it's probably best we just kind of talk about this openly and use our notes if we feel like we need to. But what we're talking about today is diversifying your portfolio after retirement.
Mhm.
For a lot of people that I've worked with and have talked to in the years leading up to their retirement, they've relied on the simplicity of like a target date fund,
Mhm.
or some very simple allocation strategies that are designed to reduce risk as your retirement rate approaches, right? Or your
Mhm.
retirement date approaches.
Right.
And and that's fine. So then, so you do that. Personally, I think there's better ways to manage a portfolio than that. But if that's what you've been doing, and now you're at retirement, so then now what? And so it probably doesn't make sense to keep doing what you've been doing. You're going to need this portfolio to last you, throughout your retirement years. Probably very commonly 20 to 30 years, maybe for some people even longer, right? And so what we need is to make sure that our allocation creates a portfolio that performs well, while also continuing to manage risk. And so it's an easy argument, I think, to make that when you retire, managing your portfolio can become a little more complex than it
Mhm.
was in the accumulation years when you were just probably had a simple allocation and were putting money in. And so, Cheri, let's just start with why diversification matters in the first place.
Right.
I can start, but I'll let you start.
Okay. The first thing you want to think about is that suddenly now, when you step into retirement, there's a real shift in your goals. Prior to retirement, your financial focus was really pretty simple and straightforward, and it was to grow your nest egg in preparation for retirement. So now suddenly your goals change, and you have maximized your returns to accumulate your wealth. And now that you retired, that goal kind of shifts. So you're no longer trying to just grow your wealth, you're trying to preserve it and to generate income from it, and then also to manage that risk over a very long period of time. So this is where diversification really becomes important. And it's about making sure that each asset plays a specific role in that financial plan.
Okay, very good. I think I'm going to say kind of what you said, but I'm going to come at it from a different angle.
Okay.
And so I also think that your goals shift in another way. And while you're accumulating and working and putting money into your retirement accounts, you're focused on growth. And now the shift is you're focused on longevity,
Yeah.
right? And so you need income and you need to live off this portfolio, but you need to make sure that it'll last. So I think both of us are saying the same thing, but we're both making different but good points
Right.
around it. So let's talk about what, when we talk about diversification, that's not simply your 60/40 or 70/30 or whatever, or whatever allocation you have. It's a little more complex than that. So let's
Right.
talk about some of the key elements of diversification. And so when we look at portfolios in retirement, one of the pieces is you need to have a part of your portfolio that is creating income,
Right.
right? So there's a good chance that you need to be living off this portfolio right away.
Hmm.
Maybe even more so in the early years if you're not eligible for Social Security yet, or you want to push that back to 67 or 70, right? And so
Hmm.
you need to have some part of the portfolio that's generating income. I'll let you speak to what you feel would be next.
Right. Yeah. You also want to ensure that you still have some growth investments, right? So, you want to protect against inflation and such. So, one component of your portfolio needs to continue to be those growth investments, even in retirement.
That's right. So some of it needs to grow. which I would say means also some of it needs to make sure that we're preserving your capital, right? And
Absolutely.
so some portion of your portfolio is going to need to be invested in things that are protecting you from a downturn,
Right.
right? And so so far we have income, growth, capital. Do you have another one?
You want to have your inflation hedges, right? The ways that you can protect against inflation, whether it be tips or those treasury inflation protected securities, commodities, and different types of alternatives that can essentially be used to help preserve your purchasing power, during those times when you need more liquidity.
Yeah, very good. So I think it's easy to see that once we retire, things do get a little more complex. We have to think about income, we have to think about growth, we have to think about preserving our capital, and we also have to make sure that we have a hedge against inflation, right?
Exactly.
And so, one of the ways that people do this is through a bucket strategy. That's a common term. There's a lot of strategies that are similar that we don't really call bucket strategies, but we'll use that terminology for the purpose of this video. So, so why don't you start us off with talking about the
Sure.
buckets? Typically, there's maybe three pieces of your portfolio that you would divide it into.
Right, absolutely. Typically, you fall into the short term or like a 0 to 3 year type of time frame for your more immediate needs. This would be your cash, money market accounts, and short term treasuries. Then you would have your mid term or like more like your 3 to 10 year type of bucket, and then you also have your long term bucket, which would be 10 or more years.
Okay, so so I think most people are probably familiar with this concept.
Right.
But I think when you look at the buckets, and then you also have the element of income assets and growth assets and capital preservation and hedges against inflation, right? That adds a little bit more to the complexities. So let's talk about when so if you're in there managing your portfolio and you're taking all of these things into account, what are some of the pitfalls, or what are some of the mistakes, or where do people get it wrong?
Yeah. So some things to be really cautious of are overlapping holdings. A lot of times, if you're purchasing ETFs or different mutual funds, things like that, that might have various types of holdings, well, you might find that you're holding in more than one location. So you want to be cautious of doing
Okay.
that.
Yeah, very good. I would also speak to sequencing risk, right?
Mhm.
And so depending on when you retire and when you're making withdrawals and what's happening with the market and the market conditions and your portfolio. So that's another thing that,
Right.
can be a pitfall for some people.
Yeah, yeah. And
Okay.
then there's also tax inefficiency concerns. We talked about before that there are certain types of holdings that are optimal in various accounts. So again, being cautious of those types of taxable considerations as well
That's,
in your
that's right.
portfolio.
So taxes is another one. We talk about this a lot, but sometimes when you retire, taxes are going to be your biggest expense.
Exactly.
And so anything that you can do to have a good tax strategy and reduce those taxes can be helpful. I want to throw in one more. And, so for some people, they get it right. They get in there, they allocate their portfolio, things look good. And then they get on with their life and enjoying their retirement. And what they're not aware of is how the risk is changing as the
Mhm.
market changes, and
Right.
how that what they allocated 6 months ago, a year ago, hopefully
Right.
not 18 months ago or 2 years ago,
Yeah.
but they've either maybe taking on a lot more risk than they intended because not just market conditions, but economic conditions changed along the way.
Right.
Or maybe the opposite. They have way too little risk, and they're not optimizing their portfolio. And so that not actively managing it and not actively reallocating your portfolio is another pitfall that we see people make, even if they initially got it right.
Right.
So okay, so let's wrap this up and just talk
Yeah.
about some of the takeaways. So one is you definitely need to diversify your portfolio. It
Mhm.
might be a little more complex once you retire than when you were in your working years. And it definitely is going to require you to be very intentional about managing your portfolio. And
Yep.
so, and you want to make sure that every asset in your portfolio is serving a purpose
Right.
that is leading to your ultimate goal.
Yep. Absolutely. And it's those components that come together that really help to contribute to that peace of mind that that well-diversified portfolio can help to bring you.
That's right. And then, I would also say that as you retire, in your working years, and especially if you've got a target fund, you're looking at retirement as the end date.
Mhm.
What you'll find when you retire is that's actually just the beginning of another chapter.
Exactly.
And your portfolio is still there and it's intact. It's hopefully probably bigger than it's ever been. And so it's definitely not the end of the story, but it's the beginning of what you hope is the best chapter of your entire life, right? And
Well,
then and then I would say that as a firm and in the financial industry, because of the points that we just discussed, this is the time when most people begin to seek help from a professional financial advisor.
yeah.
One, because they understand the importance. Two, they want to work with someone who has been through multiple market cycles and
Mhm.
has literally had their hands on hundreds, if not thousands, of other people's portfolios that look just like theirs,
Right.
right? In situations that are similar to theirs. And so, it's worth it when you're retiring to do what a lot of other people do and speak to a financial planner, a financial advisor, and maybe a professional asset manager to assist.
Yep.
So
Well,
before I wrap this up, any last comments or thoughts?
no, I thought you said put that very well put
Okay,
about intentionality.
okay, good. So let the record indicate that Cheri, for the first time I think ever, didn't have something additional to add. And but thank you, Cheri. I appreciate that.
Thank
So
you,
if
Cheri.
you're watching this video and you found it helpful, please give it a like. It helps other people find content like this and can help them along as well. Also, if you are nearing retirement or stepping into retirement or already retired, and you think that you might want someone to talk to someone about asset management or help with your portfolio or other financial planning, give us a call. We would love to give you a free appointment with one of our financial advisors. You can reach us at clientfirstcap.com. And from there, you can reach us by phone or schedule an appointment online with us as well. And so don't forget to check out our other videos for topics like this. And we'd love to hear from you. Cheri, thanks.
Thank you, Cheri.